Hello, and thank you for watching our Sunoco LP investment video, a part of the Birkenroad Reports program at Tulane University. My name is Max Malinsky, and on behalf of my analyst team, including Clark Lemons, Jacob Pritikin, James Villard, and Gregory Tulsick, I would like to welcome you to our video report. Sunoco LP trades on the New York Stock Exchange under the SUN ticker symbol. Our team developed a 12-month price target of $59 per share, which is a 15.94% increase from the stock price of $50.89 on March 17, 2015. Including our forecasted distributions, we give Sunoco LP a rating of market outperform. In this presentation, we will provide you with a description of Sunoco LP's business. We will discuss recent micro and macro developments that are pertinent to the company. We will convey our investment thesis, we will walk you through our valuation, we will explain how we came up with our financial projections, and we will describe the company's risks. To provide you with background, Sunoco LP is a Houston, Texas-based wholesale and retail distributor of motor fuel. Sunoco LP generates the majority of its profits by selling gasoline and petroleum products to its network of affiliated convenience stores, third-party retailers, and commercial customers, as well as more than 150 company-operated retail sites. As a result, Sunoco LP has become one of the largest domestic distributors of branded motor fuel in the U.S. The company also owns 6 fuel storage terminals and transports fuel through a network of trucks. Sunoco LP is structured as a master limited partnership, or an MLP. An MLP is a publicly traded limited partnership in which the general partner manages the operations of the company while the limited partner provides capital of the company and receives compensation based off the company's performance. As the owner of the company's general partner, Energy Transfer Partners receives income directly from Sunoco LP's cash flows. As an MLP, Sunoco LP gets the tax benefits of being a limited partnership while having liquidity enjoyed by a publicly traded company. As shown in this image, Sunoco GP LLC is Sunoco LP's general partner. Sunoco GP LLC is a wholly owned subsidiary of ETP. ETP also owns 42.8% of the limited partner shares of Sunoco LP. Since Sunoco LP is currently in a rapid growth phase, it has recently completed several acquisitions of strong-performing retail and wholesale businesses. In December of 2014, Sunoco LP announced the acquisition of Aloha Petroleum for $240 million. The Hawaii-based chain is the largest gasoline marketer on the island, as well as one of the island's largest convenience store operators. Sunoco LP's management expects to adopt and expand the Aloha and Aloha Island Mart brands. Aloha Island Mart has 3 core businesses: retail, wholesale fuel distribution, and fuel terminals. The acquisition of Aloha Petroleum expands Sunoco's offerings into the storage segment of the motor fuel value chain and expands its presence in the transportation segment. Additionally, in October of 2014, Sunoco LP acquired Mid-Atlantic Convenience Stores from its parent company ETP for $768 million. Max owns and operates 71 stores and 230 dealer-operated sites in Maryland, Delaware, Virginia, and Washington, D.C. Sunoco LP's acquisitions of Aloha and Max significantly expand its geological footprint and increased its third-party sites by 256. In addition to growing through acquisitions of outside companies, Sunoco LP will also grow by acquiring ETP's assets. ETP recently announced it intends to offer Sunoco LP its remaining convenience store and fuel distribution assets. Furthermore, because ETP's interests are aligned with Sunoco's, these drop-downs are likely to be made on economically acceptable terms. However, investors should be cautious of Sunoco LP's cash flow. The company's financing strategy for its acquisitions may decrease cash flows. Thus, investors may see a decrease in quarterly distributions while the company continues to acquire ETP's retail convenience and fuel distribution assets. With regards to the company's distribution growth, Sunoco LP recently announced quarterly distributions of 60 cents per unit in the fourth quarter of 2014. This distribution is up 24% year over year and up 10% from the previous quarter. This solid growth is attributed to the company's strong Q4 performance after completing their recent acquisitions. On a macroeconomic level, crude oil prices have declined steadily since June of 2014 due to a glut in supply and decrease in demand. While many companies in the oil and gas industry have been harmed by low oil prices, Sunoco LP is positioned well to ride out the storm due to the fact that a large percentage of the company's sales come from long-term contracts that agree to fixed profit margins. Also, declining fuel prices present an opportunity for Sunoco to increase its margins on its short-term contracts. In addition to the aforementioned positive developments, we feel that Sunoco is a sound investment and is poised to maintain successful growth because an improved economy and lower fuel prices will increase the demand for consumer motor fuel in 2015. Expansion through acquisitions of companies like Aloha and Max will continue to boost revenues to new highs as well. Also, the company's long-term contracts with Susser Holdings, its affiliate, and third-party customers will carry future growth and will provide steady profit margins through good times and bad. And finally, the company's strong distribution growth will draw investor attention and increase demand for the stock. We determined a rating of market outperform for Sunoco with a 12-month target price of $59 using an equally weighted average of a dividend discount model, a relative multiple model, and the company's forecasted book value per share. By using the dividend discount model, we derived a valuation of $62.15 per share. A dividend discount model is an appropriate method of valuation for this particular company because as an MLP, Sunoco's value lies in its ability to pay out quarterly cash distributions to its shareholders. In our model, we assumed a discount rate of 13.48% by adding a 9% liquidity risk premium to Sunoco's WACC of 4.48% because the company's units are lightly traded. By using the EV to EBITDA multiple, we derived a share value of $57.78. EBITDA is a useful measurement of profitability for companies with large fixed assets as it removes the non-cash operating expense of depreciation. It also provides us with a conservative estimate of value as Sunoco had exceptional 2014 performance compared to its peers. Finally, we forecasted a book value per share of $56.49 for 2015. In calculating this book value, we used a multiple of 1. Although Sunoco is performing as a high-growth company, the company has historically traded at a multiple of 1. Therefore, our forecasted book value per share is conservative relative to Sunoco's growth potential and provides a solid price floor for the company's valuation. To project Sunoco's motor fuel gallons sold, we used a production growth model which took the company's quarterly growth in motor fuel gallons sold from 2013 to 2014 and used those growth percentages to project quarterly motor fuel sales 3 years into the future. After projecting a 3-year phase of rapid growth, we assumed a long-term growth rate of 5%. Additionally, we consciously did not account for future drop-downs or acquisitions' effect on revenue, as we cannot predict the nature or timing of these events. Therefore, our production growth model is conservative. For 2015, we projected revenue of $5.17 billion, which can easily be surpassed if Sunoco LP continues to partake in acquisitions. Also, we used a conservative growth rate for retail gallons sold, which could easily be exceeded due to these acquisitions. To project the company's annual distributions, we forecasted annual distribution growth of 15% for 2015. We are expecting high dividend growth in the next 3 years as the company continues to pursue rapid growth. In the long term, growth will increase slowly and steadily since management views increasing distributions as necessary to the vitality of the MLP. Finally, 2 risks stand out as having the ability to disrupt Sunoco LP's business. The first risk is that Susser Holdings contracts generated 61% of the company's wholesale revenue in 2014. Therefore, Sunoco LP is subject to Susser Holdings business risk. Also, Sunoco LP is subject to the risks associated with its future acquisitions. These risks include possible synergy and fit problems, as well as potential risks from increases in debt and equity issuances. To conclude, we forecast a 12-month price target of $59, a 20.84% return, including annual distributions. We foresee increases in distributions to shareholders, driving demand for the equity and future acquisitions, leading to substantial revenue growth. Thank you for watching our video presentation of initiating coverage of Sunoco LP.